Hi everybody, it's Chris here from Serene Education. Just going to be going over the four majors for the second week of May. Second week of May 2015. It's the 3rd to the 8th of May, in fact. No non-farm payroll on the 1st of May. It was then pushed forward because it was Labor Day. So they pushed it forward to the following week, which is this week coming up, which is the 8th of May. So I just mentioned non-farm payroll. New month, which means the first Friday of a new month would be non-farm payroll. That was the 1st of May. Unfortunately, it was Labor Day, so they've now pushed it to the 8th of May. So we've got a lot of data coming up this following week. Just want to have a look and see what's happened over the past month. So this is the month of April, and see how she has set us up going into May. Ideally, as a trader, you want to know exactly what to expect for the following month. So therefore, I'm going to do my analysis looking at the bigger time frames and then working my way down into those smaller time frames to better get an idea of what price action is doing, where the buyers and sellers are, which will then give me a far better outlook as to where I should be putting, where should I be trading going forward into May. So let's start with euro against US dollar. So straight off the bat, look at the indicator box, and I see a mixed picture. The sentiment long term is still negative, but we're seeing a bit of uncertainty creeping into the weekly time frame. Negative in its outlook. So yeah, looking at the monthly time frame, clearly negativity. However, looking at the intraday, you can see that the institution moving average in particular is below price on our 4-hour, hourly, 30-minute, and 50-minute. So if I'm looking at negativity long term, I don't want to see the institution moving average below price action on my intraday. I'd like to be above. So that would be clearly going against long-term trend at the moment. So I'm seeing consolidation. And if I look at price action for April, you'll see that April's candle actually moved higher. It actually moved entirely, it pretty much engulfed the whole of March. So we saw a lot of negativity in March. So therefore, for April, we're looking for further lows, continued lows with long-term trend for further negative bias. However, we failed to see that actually really occurring through March, i.e. no new lows on the weekly, which would then mean there was no new selling opportunities on our daily, 4-hour, etc. And vice versa, what's happened is we've seen more buyers coming into the market, and we've seen a lot more negative news out of the US market, which has had a positive effect on euro against the US dollar in this case, which has forced price in the opposite direction. So what it's done is now, it's created a tweezer bottom. Now, a tweezer bottom, railway tracks is another word they use, is an indication of a change in market bias. In this case, negative bias to the downside for a prolonged period of time on the monthly, followed by a very bull candle in the opposite direction, which has engulfed the prior candle. In this case, we're looking at monthly, so therefore we're seeing a lot of buyers coming into the market over a longer period, i.e. 4 weeks. And that's, as I mentioned to you before, it's predominantly to do not with great euro data, it's more to do with negative US data. That started right off the bat in the start of non-farm payroll in April, when we had some really negative figures for non-farm payroll. And that pretty much stemmed the flow of the data that came out of the US economy, which just made it even worse. And subsequently, we've seen price pulling back. So looking at the weekly time frame, you can clearly see that we haven't seen any new lows since the early March. And subsequently, when we went into April, we saw a nice sell-off in April because as we headed into non-farm payroll. However, when non-farm payroll came out, it was positive for euro, which formed this support level here at 1046. And subsequently, since then, over the last 3 weeks, in fact, we've seen nothing but bias to the upside for euro against a very US negative dollar. So yeah, what it's done is it's clearly moved back up to price support and resistance levels, i.e. the support and resistance level that made up the January 15 low, and back to the 20-period moving average, which has acted as a resistance level of price over the year. The best part almost of a year now, in fact. So we're seeing, the weekly candlestick over here. The institution moving average is still above price, clearly above price, as well as the 20 and the 50, which is a negative signal. However, you can see that our other indicators here, the MACD, which is trend related, which is the most important one. If you are trading trends, you'd like to see the MACD obviously complementing that trend. Okay, so if we're seeing the MACD giving us a totally different signal, then we've seen obviously a crossover. The last time we had a crossover was way up here. Now we've had a crossover, so the trend is now pretty much nullified, and you can see that over the last month or so, price has not made any new lows. In fact, she's actually made she's crossed over and she's reattempting the prior highs, but more so in a consolidative range. So candlesticks are still negative. We do have a blue arrow though, but the candlesticks are still negative, and that still paints a negative bias for euro. We are seeing negative data out of the US market. However, euro, the way things are stacked up in euro at the moment now, it's still a lot of uncertainty, and that's uncertainty still surrounded by, or it is led by that uncertainty which lies within Greece. Okay, so having said that, Greece is going to be quite interesting because we're going to May, June, July, and a lot of those loans that Greece have taken all start to mature, and they all need to be paid back. It's going to be interesting to see if they are able to, and this is where the question mark leads to euro going forward. So we've seen a pullback, and as I mentioned to you, it's not because of euro positive data, it's because of the US negative data that we've seen over the past month. How long will it continue? We are at a major support and resistance level right now, and if I was to draw some levels on here to indicate what we should be looking for going forward, we could take the current resistance level high that we saw way back in mid 2014 to the current low, and you can see that the level right now, price actually tested it this month, was the 23.6 fib retracement level, which is at 11300 and change. Okay, so we can take this level out, which is my horizontal line I drew it myself, and you can see prices at a fib level of support and resistance. So ideally, if we are looking into May for further pullbacks, then ideally we'd like to get above that hurdle, which in this case is the 20-period moving average. And if you look at them weekly, we haven't been above the 20-period moving average ever since price actually rolled over in the early parts of 2014, in fact. So we are now at a crossroad level where something's going to give. Either we're going to see further negativity for the US dollar, which is then going to have a positive effect on any crosses with the US dollar. Okay, it's not going to say that we're going to get positive data out of Europe. It's just that when one's down, the other one's going to kick the hell out of it. And that's pretty much what happens in currencies. If one is negative, the other one's definitely going to be making headway on its negativity. And that's what we're seeing. So if we are to see any further continuations of bullish consolidation on the weekly and daily and stuff like that, then ideally what we want to see out of May in particular is this 23.6 fib level here being breached for us then to look to target to the upside. And the next potential level for May would be the 38.2 here at 1181 and change. And we're looking at roughly, there's 489, not going to get all of it, but there's more than enough on the table to see a valid return on time invested. There again, we do need to see the daily this week, the second week of May, seeing euro continuing its bullish uptrend that we've seen, or intermediate uptrend that we've seen recently. You'll notice on the daily now, I do have a blue arrow and the candlestick for the first time in as many months. I don't think we've had any blue candlesticks at all since May of 2014, in fact. So seeing the MACD really starting to show a change, and we're starting to see more bullish bias coming into it, signifies that we could see a potential change in trend direction. However, saying that, we're still below a major support and resistance level on the chart, which happens to be the 23.6 fib level. So ideally, yeah, as long as it continues to be blue, above, perfect. You can see on the daily now, everything's looking fantastic. The only thing out of place is the institution moving average, because if it's positive, you would like to see the institution below price, and you can quite clearly see the institution is way up there at the 38.2, which would be effectively our next target if we saw a break and close higher than the current level here. So that would be our requirements. Look to see US data to see if it's actually positive or negative. That would be the best thing to do now. So we look at this week's data. We're going on to Friday. Let's have a look at the non-farm payroll figures. Non-farm payroll, you can see quite clearly there, April 126, very negative indeed. And they're expecting almost 100,000 new jobs to be created through April. So if that is correct, then that would have a positive effect on the US dollar, and vice versa have a negative effect on euro, which is already in a negative trend. It's just been consolidated predominantly just because of bad data we see in the US market. So there again, it'll be quite interesting. The unemployment rate is dropped slightly to 5.4 expected, and that's what we would like to see coming out of the US market. If we go down onto Wednesday, the 6th of May, we also have the ADP non-farm employment change figure, and they see a rise there as well. So employment up, that also have a positive effect on the US dollar. So if that is the forecast, and we do see that happening on the charts, then we could clearly see a continuation, a reversal continuation with the long-term bias here for euro, which is weakness at this level. So 23.6, 1.13 level is going to be vitally important for euro this week, guys. We've got to see a daily candle close higher with genuine sentiment for them to open up a quick, aggressive trades, ideally to the 38.2, but in between all that, we have a clear consolidation level here as well at roughly the 115,597 and change. And between the 23 to that level, you're looking at an excess of 250 or 260 pips. Not going to get all of it, but thereabouts would be a vital target. So very interesting one to keep an eye out on going into May of 2015. Moving on to sterling. Monthly here again, just look at a quick glance at the indicator box. Long-term sentiment is still negative on the monthly. However, that weekly and daily is starting to look positive, and it's predominantly the overall bias intraday is negative, which is good because it's moving with the long-term monthly trend, which is negative. Perfect. However, the weekly and daily are showing positiveness, predominantly because we've seen consolidation on those time frames, and you can quite clearly see where price is trading right now. You'll notice that we've seen consolidation in and around an area that was a major support and resistance level in 2013, in fact. So below those two levels, yeah, the major one would be down here, which is around about the 142,136 and change level. But you can see after a nice bear continuation candle in March, we failed to see price taking those levels and moving further to the downside on that breakout. So we had a consolidation range for January, February, and then the March breakout. But we failed to see price really moving. We did see price trading lower on the weekly time frames on the April, however, failing to close low. And I'll just give you an indication of that when we drop down to the weekly. So here's a weekly time frame. Each one of these represents a week. And if you look at the bias going into March, you're seeing, oh, perfect. Yeah, fantastic. And then there we go, March. And then we went into April, and that was the candlestick we were looking for. So we thought, well, that's perfect. That's exactly what we wanted to see. A nice bearish engulfing candle closed lower. Looking at the overall bias, red arrow, red candles, RMO below, the OSMO was below. Perfect. That's what we wanted to see. So what we'll do is we drop down now to our daily time frame for the forthcoming week, which will be this week over here. So draw a horizontal line on the low of that candle. Perfect. Whether you take the body or the wick is entirely your choice. You can take the body, drop down to the daily. Perfect. There's the daily range or the support level. So Thursday and Friday, a lot of selling, which is great. Then Sunday and then Monday. This is the day we want to see a continuation of the negativity we saw the prior week. But that didn't happen because Monday's candle actually closed higher. So almost a hammer formation here at the start of a new week. And subsequently since then, we've not seen price actually making new lows. In fact, she's actually been climbing aggressively in the opposite direction. And that's predominantly because of the bad non-farm payroll figures that came out of the first Friday of a new month. And subsequently, the following week, all the further negative data that came out of the US market had a positive effect on sterling. And obviously, we saw price climbing very aggressively in the opposite direction. So much so that we actually saw price heading way back to price support and resistance levels that we saw back in early February of 2015, which happened to be the institution moving average. And since we got there, you can see prices now falling over. So people buying here aggressively after all that bad data. And then when getting to this level, going into the end of the month, people started to take profits. And subsequently, we've seen sterling pulling back sharply against the US dollar. So what does it mean for this month, in fact? Well, there again, you can see that price actually came unstuck at a price support and resistance level, but also the institution moving average. Candlesticks on the daily are blue. We had one or two areas where we were blue, but here blue trading into a price support and resistance level. Not really what you want to see. You want to see a continuation, which failed to materialize, as we saw a bearish engulfing candle, even though they were blue. Bearish engulfing candle here confirmed there were far more sellers in the market than buyers, and subsequently price rolled over. Here again, blue arrow, blue candlesticks, RMO above, OSMO above, but we're still trading below the institution moving average. Ideally, we want to be trading above the institution moving average if we are seeing clear bullishness. And you can see here on the daily, because this represents a day, you can see that the institution moving average is still above price because it's red. So here, if we are to see any further positiveness for sterling and weakness for US dollar, we would obviously need to see the fundamentals doing exactly that, i.e. non-farm payroll coming out worse than expected, or the opposite would be positive US data, non-farm payroll figures, which would have a negative effect on sterling, and sterling would do what it's been doing for the last 8 or 9 months, is to trade back low or trade backward long-term sentiment, which is negative. So back below the 151359, and then we could see price heading back towards those March and April lows here at the 1473 level. So here again, if we fail to see the institution moving average being broken on the daily, i.e. new highs being created, there's less likely of further bias to the upside, and what would happen is we would see a continuation in what is still a negative long-term trend, and that would be seeing prices rolling over and then re-attempting these levels to the downside here at 1473, etc. for the month of May. Moving on to the US dollar Swiss franc. Here again, guys, negative news out for the US dollar had a positive effect on Swiss franc and vice versa. You can see that we actually had a bearish engulfing candle formation on the April close. Having said that, though, she still failed to close lower than the January low. Okay, vitally important. You can see on this particular pair we've had a major support and resistance level over the years, and prices fell that level in April, fell that level again in March and April. You can see the bearish engulfing candle confirming that this level here at 9950 and change is clearly a resistance level of price, therefore forcing price back down, in this case back to the price support and resistance levels or consolidation levels that we saw through January and February of 2015. So what are we looking for going forward into the month of May? Looking at the indicator box, you can see a lot more negativity, and you'll see the monthly time frame and the weekly pretty much speckled. But you look at the chart and you can see on the monthly a lot of indecision because price is not made any new highs and she's not made any new lows. In fact, she's actually just been trading within a very horrible range over the past couple of months. Not really great for trading, and one that I've not really traded as much in 2015 as I've done going through 2014, in fact. So when we drop down to the weekly time frame, just wait for it just to load up, you'll see that clear indication of that consolidated range that we see on the monthly time frame. The weekly, there's a lot more positiveness in this particular level. There we go. You can see the candlesticks. She's finally decided to refresh herself. But what we still is, you can see positiveness. Candlesticks have been pulling back because of the negativity we've seen through. But the bias for the US dollar is still far better than the Swiss franc. Having said that, though, if we fail to see any new highs going forward into 2015 and no reattempts of the current resistance level highs which we saw in January and yet again in the early starts of March, here at 1015 and change, then there's more likelihood for price to continue to consolidate and eventually to roll over to negativity. So here, what we want to see for the US dollar Swiss franc, you can see a negativity on the last week of the month of April, but she's still above the institution moving average. Okay, so if this is to be genuine negativity, then ultimately when we look down to the daily time frame, etc., we would want to see a continuation of that negative trend. But saying that, we have a lot of data out for the first week of a new month. First week of new month, which would be non-farm payroll figures, and they expect the figures to be positive. So if we see a lot of negativity through the month of April, then that would have a total opposite effect on what we're seeing at the moment now in terms of price action. Price action at the moment now has been dropping since March. Now, if we're going to see positive non-farm payroll figures, that's going to have price moving in the opposite direction. So the only thing that's going to rebuke that is going to be further negative data that coming out from non-farm payroll. So the forecast is to be positive, and the only thing that's going to really change that mindset is for the forecast to get totally wrong in this case, and we see further negativity. And if that was to occur, then we could see price, if I take the lows that we saw in January to the current resistance level higher, you can see we're trading below the 23.6 level. If we do see a continuation of negativity for the US dollar, then the 38.2 here at 0.9145 and change would be a valid target level for May, and vice versa, the 50, the 61, and 78.6, which is way down here. Otherwise, if we see positive data coming out end of this week, then what we could see is price retesting the 23.6 level, which is the prior major support and resistance level of price that we've seen over the months here at 95200. So we could see price moving back again or reattempting the highs, or the support and resistance levels here at 9528, which are roughly around 200 pips away. So vitally important to see that. At the moment now on the daily, you can see we have a negative arrow. The candlesticks are negative, RMO is below, and the OSMA is below. So it's going to be quite important. If you are looking to trade the US dollar Swiss franc, please be hesitant. A lot of the data coming out from Wednesday through to Friday looks good, and if it continues to be projected as good as they expect it to be, you're going to see the US dollar going in the opposite direction of what price has been doing over the last couple of months. And you don't want to be caught trading these particular pairs when they're going in the opposite direction of what the price action has been doing. So here, it's still within a consolidative range. It is still very much a very horrible consolidative range, and it's one that we should rather just stand aside for before we get a real clear directional movement on this particular pair. So as it stands at the moment now, treat it with a lot of respect, because below on the weekly we still have the institution moving average, and it'll be interesting to see how these figures come out for the US market this week. If they don't come out as expected, we could see a very, very sharp fall for price going in for May for a further negativity of the US dollar against all its crosses. So just be vigilant and keep your eye out on price action. Last pair is going to be the US dollar against the Japanese yen. There we go. And looking at the monthly time frame, here again, quick look at the indicator box down the bottom. A lot more positive, not much red in this particular pair. However, looking closely at price action herself on the chart on the monthly, you'll notice that there's a lot of hesitation where price is trading right now. No new highs, a lot of indecision candles in fact, and that's predominantly because if you look back in the past, you'll notice that price actually came unstuck through 2005 to 2007. So almost a 2-year resistance level here. So anybody who was buying effectively way down here in 2012, for example, or buying recently as such as 2014, the end of 2014, would have looked at this potential area as a major target level. And once we got to that level, you can see a lot of uncertainty coming into 2015. But that's predominantly off bad data that's come out of the US market. Especially the people, the Republicans and the Democrats, etc., are getting a bit skittish now. They're looking to Fed, especially Yellen, in terms of answers as to when and how far from now are we likely to see an interest rate hike for the US dollar. However, having said that, a lot of negativity on the US market, you can see the reason why Yellen is very, very apprehensive to raise interest rates at this current time. So we're seeing that data predominantly probably being put off for the time being, maybe into the third or fourth quarter of 2015, in fact. So a lot of indecision, which has painted a lot of candlesticks that don't show a lot of true directional movement. Spinning tops, dojis, not good, because that tells me straight away there's a lot of indecision between the buyers and sellers. And what I don't want to be doing is trading when there's a lot of uncertainty on the markets, because all I'm going to be doing is risking a large proportion of my trading capital and ultimately potentially losing it, because the risk is that much higher. Looking at the weekly time frame, you can see the past 5 weeks in particular, price has not been able to make new highs, and subsequently not been able to make new lows. So she's been consolidating, ranging, not worth trading, guys. So if you are looking to trade this particular pair, we do have a start of a new month, a lot of new US data this week, in particular from Wednesday right through to Friday, which is non-farm payroll. There again, it's the US dollar against the yen, close companion, close symbiotic relationship between these two particular pairs. Vitally important that we either see a new highs, because the overall bias is still to the upside, but that would mean to see positive non-farm payroll figures, and vice versa. That would then lead to further ups, and we can then start to look to trade with further continuation. Having said that, if we don't see that, then price still gets stuck between the sandwich between the high and the low, those two vertical horizontal lines you see in the chart, then it's not worth trading it, because you're just putting that much more risk on the table trading this particular pair. Far better just to look elsewhere. Maybe look at euro yen crosses, sterling yen crosses, Australian dollar yen crosses, New Zealand dollar crosses, New Zealand yen crosses, etc. CAD yen crosses instead of looking at the US dollar yen cross at this current time. So there again, do your due diligence, back it up with sound money management rules, and you're more likely to come out being a winner at the end of it. Okay, guys, that's a quick look into the 4 majors for the month of May. Do your due diligence, as I mentioned, back it up with sound money management rules, and most importantly, keep it as mechanical as possible. Don't try and guess what the market's likely to do. The candlesticks will tell you what the bias of the market is. We then just back it up with sound money management and then trade with long-term sentiment. Hope you have a fantastic weekend with family and friends, and I'll see all you guys again sometime on the forum next week. Until then, you guys trade serenely.